High bond yields and rising inflation are spooking debt fund investors. Given the current volatility in the equity market, where should investors seek haven? If you are one of those who cannot track the macro environment, as there are many moving parts given the seesaw journey of crude and political issues with Russia and Ukraine, how about looking at passive funds? Let's get you a deeper understanding of passive funds, how they work, and how much return expectation should you be keeping from it. We have with us Pratik Oswal, Head of Passive Fund Business, Motilal Oswal, AMC and CEO, Glide Investment. Good evening, Pratik, and welcome to the show. Let's start by talking from a perspective of an investor who just thought of getting into the market and obviously scared of the volatility, but also thinks that has missed the last 2 years' return that that person could have made. Starting off your investment journey in this current scenario with a passive strategy, how does it sound to you?
Yeah, thanks for having me on the show. For a new investor, I think passive funds are extremely easy. They don't have to go out there and select between the hundreds of options that you have in the marketplace. I think a lot of people, when they think about passive funds, they think about Nifty, Sensex, but actually, you can find passive funds across all categories. You have passive funds in the equities, you have passive funds in debt, in fixed income, you have passive funds in international, in gold. So I think you really, can really build an entire portfolio if you want, just by using passive funds. Coming to the investor who's coming for the first time, I think it makes sense for him or her, if they do want to go out there and build a portfolio, to maybe choose one passive fund across each category and really structure their portfolio in such a way that if they are a little bit more risk taking, they can have a larger sort of portion of the portfolio in an equity passive fund versus a debt versus gold versus international. So I think that's how I would sort of go about building the portfolio in today's time.
I've always heard you advocating a diversification strategy when it also comes to passive investment. Now, having so many avenues to invest in a passive strategy really makes you reconsider or maybe think about new investment instruments in your portfolio. Talking about diversification, how should one diversify if you're just beginning your investment journey across market caps, international funds, not to forget? Do you think it's a time to diversify passively into international funds also?
Yeah, so I think diversification is extremely important for all investors. and the reason why diversification is important is because today times are extremely volatile, so you really can't say which asset class does well or which does badly. So if you have your money sort of split across equity, debt, international, gold, say real estate, in form of a REIT or something, then you're not really exposed to asset specific risks. Say tomorrow the market goes down, then your portfolio obviously will stay stable because you're diversified across different asset classes. So I really believe that diversification is something that most investors should do it, and not really diversify by looking at a large cap fund and a mid cap fund. Honestly, if the market goes down, both will go down. But I think it's important to diversify across asset classes, because that's when actually diversification works really well for the investor. Sorry, could you just repeat the second question?
Sure. I wanted to understand how could you diversify passively into international funds given the scenario that a lot of AMCs now, due to the limit put by SEBI, are not able to put investors' money into the international market. So passively, how do we do it?
Yes. So unfortunately, I'm also part of the AMC where we're not able to accept new flows either from lump sums or SIPs. But there are funds available. There are, I think, a handful of funds available. I think there is 2 or 3, passively managed funds. There is a couple of Nasdaq funds that are open from other AMCs. Also another S&P 50 fund which is also open. So I think there are a few options, although very limited. The industry, as a whole, is sort of waiting for new regulations to come in place. But till then, I think if investors really want to go out there and build a portfolio, there are a few options out there. But but I would recommend investors to slowly wait till the limits are raised before they can go out there and deploy money in international funds.
Pratik, talking about specifically mid-cap and small-cap category, do you think going the passive way would really earn you good money, and also, you could run away from the volatility, or it won't touch you?
Yeah, so that's a very interesting question because, I think if you look at volatility in general, historically, mid caps and small caps are a lot more volatile than large caps. So a mid cap index or a small cap index will be a lot more volatile than a large cap index. So for an investor who's not looking at, exposing himself or herself to volatility, then it makes sense to, stick to a large cap passive fund. Ideally, but also, talking about a alternative scenario, you also have something called factor funds or factor passive fund, which are also index funds and ETFs. So there is a strategy called low volatility strategy, which is something that investors could look at if they're looking at investing in this sort of a time. Just to give you some brief numbers, I think the market has fallen since March about 9.5%, whereas a low vol fund has fallen by say 2.5-3%. So there are certain strategies that investors can avail of in different market conditions. I think if someone is looking to sort of restrict the volatility in their portfolio, they can go with say a large cap fund, which is a lot less volatile than a mid and small cap, or they could also look at these factor funds, if they're looking at sort of minimizing volatility for their investments.
Do you think factor investing or factor funds really suit any current scenario, or they have a tilt towards certain stocks performing in a certain way during a certain market period?
Yes, exactly. So, ideally, if you look at factor funds, and there are many different type of factor funds, you have momentum-based funds, you have low volatility-based funds, you have quality-based funds. So it really, so there are more sort of strategy funds where investor can really invest or bet in a strategy. A lot of investors who are looking at outperforming the index or alpha strategies, do look at, factor funds because historically, they have proven to sort of outperform the index. However, it's important to understand that it does not really work in all market conditions. So, previously I talked about a low volatility fund. It really works well in a bear market, but it does underperform in a bull market scenario. So, if you're looking at a factor fund, I think it's important to do your research and be able to sort of accept underperformance as well as outperformance. Also, so I think that's something which investors should keep in mind when you're investing in a factor fund. Ideally, you should look at it from a long-term perspective. When you're looking at sort of betting on these sort of strategies.
Since you head this particular division, tell me, how has the inflow been in the passive areas, almost like since last 2.5 years maybe, and now since we are witnessing so much of volatility in the market?
Yeah, so passive is a very new category. Since we started, since at least I was involved about 3.5, maybe 3.5 years ago. There has been a lot of interest coming in passive funds, and I think a lot of it has come in from a lot of new age investors who are looking for simpler avenues when it comes to I think creating wealth. There are a lot of options out there. As you know, the investing universe keeps on getting expanded. So I think passive funds offer a lot of simplicity out there for investor who just wants to build a portfolio. To give an example, there are a lot of mid-cap funds out there, but if someone just wants to get access to a mid-cap index or that profile, they can just simply go with the passive funds and they're done with it. The reason why passive funds have also grown a lot over the last 2 years is because performance of passive funds are now pretty much on par with actively managed funds. So I think investors are not really wary that they won't be getting as good a return as they would have in the past. So I think that's also another reason to why you've seen a lot of flows in the industry. I think I believe as of today, approximately 15% of the mutual fund AUM is actually in passive. Up from I would say in smaller single digit, which was 3 or 4 years ago. So there's a lot of interest coming in from passive funds. A lot of it has come from pension funds, but even if you sort of take that out, you've seen millions of investors have come in and now are adopting passive funds, either in the form of index funds as well as ETFs.
One thing I want you to talk about, or maybe explain our viewers and investor, is having a passive strategy in a space like mid cap and small cap doesn't make your portfolio volatility proof. You will still face volatility, but maybe the magnitude would be less. So how would you explain that?
Yeah, so when it comes to exposure to small and mid cap, essentially, and this is very important, that you will. So historically, if you look at volatility, Mid caps, because of its nature of buying smaller companies, will have a slightly higher volatility profile than a large cap fund, and the same is from a small cap. So essentially, I think if you're looking at and if you look at, say, more conservative investors, the reason why they only stick to large caps is because large caps tend to be the most stable and the least volatile in nature if you span across large, mid, and small. So I think that's why if you are looking at a mid and small cap strategy, and if you are sort of lured by the higher returns that are sort of there in terms of these strategies, then yes, they do offer slightly higher premiums, but it also comes at a cost, and the cost is volatility. So which is why I think investors really need to figure out what their risk profile is before going out there and buying small and mid cap indexes or even managed funds. You should really look at the sort of risk that you can take before going out there. So I think that's very important when it comes to building a portfolio.
Pratik, I think active versus passive has been a debate since a very long time, and not only in India but globally, where we see the passive trend really going on too soon. But talking about investing in a passive way, going through an index fund and going through an ETF, which would give you better return and would be cost effective also, because these days I have realized, at least as per the kind of queries we get, people are also understanding what all expenses get into investing through a mutual fund. So how can we earn better?
Yeah. So obviously you have this debate about passive and active, but you also have a debate between, should you invest in ETF versus an index fund? And, the simple answer to that, I would say is, whatever is convenient to the investor, because there's pros and cons for each. And I think it really comes down to convenience of an investor. Just to break down some of the differences, ETF is a passively managed funds that's listed on the exchange. So just like you're buying a stock, you can buy a Nifty 50 ETF, on the exchange on BSE, NSE. So it's like buying a stock, but you're actually buying a fund, as opposed to an index fund, which is a more of a mutual fund format where you can set up SIPs. You don't and you obviously get the end of day value, as opposed to an ETF where you gain the live price. So I think those are some of the main differences between ETFs and index funds. The reason why, at least in India, in the US, ETFs have done really well is because there is a specific tax advantages that ETFs have in the US. So because of those tax advantages, ETFs have now become the dominant sort of way of investing. But in India, you don't have those differences. So far it's been pretty much, I would say, 50-50. I would say that, if people are looking at something simpler, an index fund is a lot simpler, because you don't have to worry about your purchase price or your sell price. Whereas an ETF, there are instances, many instances, where you really have to be careful about the price you're paying for, as well as the price you're selling it for. Because, for example, if the ETF should be priced at, say, 10 rupees, there might be a good chance that it might be trading at 11 or 12 rupees on the exchange. So an investor has to be a little bit more careful when they're going out there and buying ETF versus buying an index fund. If you are buying an ETF, then ensure that it's called the impact cost, the price of the ETF versus what it's trading on the exchange. That has to be extremely small. But overall, if you look at net returns, they both, in my opinion, have delivered the same returns to investors. It really depends on convenience.
Last question to you. Definitely, it's all about simplifying your investment, and you should have the ability to understand what kind of investment instrument you're opting for. Now, for someone who is just starting the investment journey, we talk to a lot of active fund managers, and they all say that you should bet on active funds because the Indian fund managers have the ability to generate alpha for you. Now, talking about a mixture of active and passive, what according to you should get into the passive kitty, and what according to you should get into the active kitty?
Yeah, so obviously, I think I'm not denying that there is no alpha. I definitely believe in there is obviously proof where a fund manager is able to add value to the customer. But if you look, and even if you look at the US, so I actually used to manage money for investors about 4 years ago, and this is in the US where passive has been there for many decades. And an average investor, what I saw, had a 50-50 split between active and passive. In India, if you look at the average portfolio, there is almost zero passive. Not many people have passive funds in their portfolios. If you take out the institutional money in passive, it's still very small, maybe 40-50,000 crore of money is being invested by people as opposed to, big organizations. So I do believe that today the penetration in passive is quite low. And, we think that, ideally you should have, a minimum of, say, maybe 20-25% of your portfolio in passive areas where you think that you're not able to find the right fund manager. That's number one. Number two, if you're looking for, say, a specific type of a fund where you don't want to do the research or you don't have access to good advice, then a passive fund can do the job for you. So if you're looking at an international fund and you can't really decide which fund to buy, there's like 10,000 options, and a simple passive fund does the job for you, gives you that exposure. So it really depends on investor to investor. I think it makes sense to have some of your portfolio invested in passive funds, but also if you have high conviction on some portfolio manager or asset management or AMC, then yeah, it makes sense to have a combination of both.
At least if you're planning to start your investment journey, you can definitely opt for a passive strategy, a passive fund, and later on you can study about the AMC and the fund manager and go for a mixed strategy. Thank you so much, Pratik Oswal, for removing time and talking to us.